If you're thinking of buying or renewing your mortgage right now, you probably realize that nothing in this market is predictable anymore. And for people who are buying and selling in the market, it's not just about that buying and selling decision. It's really about having the right strategy. So today, I'm really excited that we have one of the top mortgage specialists in Vancouver, and I'd say in Canada, here with us, Amyn Nathoo from TD Canada Trust. He's been in the industry for over 20 years, has funded almost $2 billion in mortgages. He's highly experienced and very strategic about guiding his clients from everything from their first purchase to moving up in the market to downsizing, investing, even builders. You've worked with them all.
That's right. You name it. I've seen it all.
So we're very happy to have you here today. And for those of you that don't know me, I'm Adina with Oakland Realty. I'm a local real estate agent here in Vancouver, and I help clients buy, sell, and make strategic decisions here in Vancouver's real estate market. So let's jump right into it, Amyn.
Sure.
Lots going on right now. Everyone's talking about rates and what's happening in the market. Yeah. What are you seeing in the market right now in terms of fixed rates, variable rates, forecasts for this year?
Yeah, I mean, we get that question all the time. People often say, am I better off with a fixed rate mortgage or a variable rate mortgage? And my answer back to them is always, it depends on your risk tolerance. Right now, for every 10 clients we talk to, literally 5 are going fixed, 5 are going variable. Obviously, with the current state of the world right now, a lot of uncertainty right now. So if you're of the belief, there's going to be volatility to continue moving forward, and you're comfortable with getting a fixed rate and just want to lock it in and forget about it, it's not a bad idea. But you also have the other thought process where if there is potential cracks in the economy, which some people do feel, the Bank of Canada may need to cut rates in the future. Again, we don't know that yet. And if that happens, variable could be the better choice. So again, this depends on the actual person.
What's the difference right now, like the rate differential, if someone's going fixed versus variable? Like right now, they're saving money by going variable, correct? It's just you're taking
right now
more
they
risk.
Are. That's correct. Yeah. So variable rates right now are kind of hovering in the, call it 3.6-ish range. Okay. And fixed money is kind of in the high threes, 4% range. So I would say the spread right now between a variable rate mortgage and a fixed rate mortgage is probably like 30 or 40 basis points. So for some people, they're like, well, that's not that big of a spread. I'm going to take fixed. But if you take a variable and you're saving 30, 40 basis points and the Bank of Canada does cut rates in the future, that could be a difference that ends up being, 60, 70, 80, so on. So
that's on $1 million mortgage, let's say, that 30, 40 basis points.
Yeah.
What kind of a difference would you be looking at over that term of that mortgage, do you think?
Yeah, that would be approximately about $300 a month.
A month difference.
On that, yeah. So now a lot of people can take a variable rate mortgage and then lock it into a fixed rate in the future. All right. So there is one big misconception about variable rate mortgages that, your payment's going to change. Yeah. It's not necessarily the case. So with variable rate mortgages, the payment stays the same. Yeah. It's the allocation of principal and interest that changed. So from a cash flow perspective, it's the same as a fixed rate mortgage. You're paying the same every month. But with a fixed rate, payment doesn't change, rate doesn't change. With the variable, payment doesn't change, rate can change.
Right.
That's the difference, right? And with what we saw during COVID and so forth, there was obviously a lot of people saying, okay, I'm going to take a variable at, 1.2, 1.3%. The next thing you know, that rate's like 6-7%. Obviously, nobody knew that was going to happen, but here we are later, kind of, and people coming up with these renewals, and now dealing with these with the higher rates right now.
What kind of risk do you foresee in terms of rates going up this year? I know it's very hard to predict, but
yeah, I think the narrative has changed the last few months, especially with the geopolitical issues in the Middle East. So prior to that, the bond market was quite stable. The bond market essentially dictates fixed rates. So as if the bond yields go up, fixed rates go up because the cost of funds go up. So over the last, I would say 6 weeks or so, the bond market's probably gone up 40, 50 basis points, right? Yeah. And that's primarily due to inflationary concerns with the price of oil going up. So if things subside, we could see the bond market stabilize, even come down, right? But if things stay the way they are, intensify, it could trigger rates going up in the future. Again, we don't know that right now. So it's just in a very uncertain, volatile time right now.
And the variable rates are based on the Bank of Canada rates, right? And that's more based on our own.
That's correct. Yeah. So the variable rates are based on the Bank of Canada rate. Bank of Canada has, when they have their meetings, they'll either stay neutral, increase, or decrease. So right now, the expectation is they may hold the way they are. So with the variable rates, again, this is based on your risk tolerance. If you're of the belief that the economy is going to get worse, Bank of Canada may need to cut rates to stimulate the economy moving forward. If you're of the belief that these inflationary concerns are going to get worse, then they may have to raise rates. And this is like a real time where it's literally nobody knows. And hence why we're seeing 5 out of 10 people going fixed. And yeah, it's never like that. Usually, depending on market conditions, we kind of see a trend, because the product choice that someone makes is indicative of the time they're choosing.
Yeah.
Right?
Yeah.
So right now it's 50-50, typically not the case. There's usually markets where you see big chunk going fixed, less going variable, or vice versa.
Right.
And right now we're kind of seeing half and half, and that's primarily due to the uncertainty and the small spread between variable and fixed.
One of the big things that's happening right now is this renewal wave, right? We talked about a majority of mortgages in Canada are coming up for renewal.
Yep.
And a lot of people are faced with that decision to renew, but there's also the option to refinance. And a lot of people don't talk about this, is what's the difference between renewing and refinancing your mortgage?
Great question. There's a big misconception out there that renewals and refinances are the same thing, and they're not. So there are kind of pros and cons to both. So let's talk about renewals first. So let's just say somebody took a mortgage in 2021 at a sub 2% rate. Let's say they were one of the ones that picked a fixed rate mortgage. They're not coming up in 2026. Right? It's five years later. So for people that are renewing, there's no cost, there's no application fee. You're just essentially taking the renewal rates from the lender and signing a piece of paper, and you're moving on. No qualification is needed. So it doesn't matter what your financial situation is, the bank will renew your mortgage.
So even if you've lost your job in the meantime, or your house value is dropped, it doesn't matter. They're not reappraising your house.
It doesn't matter. It's irrelevant.
Okay.
However, you are bound to your contractual obligation on the amortization, meaning if you took a 25-year mortgage and you're now 5 years into it, your new mortgage is going to be a 20-year term. If you took a 30-year mortgage, you're 5 years into it, you're now taking a 25-year mortgage. So if you are renewing, yes, very simple, but you cannot go through increasing the amortization unless that would be a refinance. So for people just looking for very simple, renew it, they're happy with the rate that they're getting, path of least resistance is definitely a renewal.
But then that sounds like, since you can't extend the amortization, your rate is higher, your payments are going to be much higher.
That's correct. Yeah. So just as an example, let's just say $1 million mortgage, 5 years ago at 1.59, 1.69%, depending on what month you got it in 2021, and now you're renewing at about 4%-ish, approximate for high level numbers. Your payment's going up by about 30%.
Okay.
Right. So let's just say somebody had a monthly payment of $3,500. Now their monthly payment's going to like $4,500. So for some people that can stomach the extra $1,000 and they don't want to go through the refinance, not everyone loves going through paperwork. It's kind of a pain, right? So who loves that? So if you want to go through the renewal process and you're comfortable with the extra $1,000, totally fine. But again, there are some people out there saying, I can't afford that. Obviously, the cost of living has gone up a lot, and they want to look at other options like refinancing. So if you do refinance, now it's a brand new application, new income, new application, new appraisal, new legal, everything. It's a brand new process. However, you do have the option now to potentially shop around to a different lender. You're not stuck to your lender, and you can reamortize back to 30 years. So there are some. So again, it's not one's better than the other. It's different based on your personal situation.
So you're seeing now, many people who have bought in the last 5 years. Their property value may be worth less than what they purchased it for. So I guess, would that limit your ability to refinance?
It does for sure, especially if you bought it the last couple of years, especially in a condo. The values are probably lower than what you paid for it. Single family, we're not really seeing that. Single family, for the most part, held up a lot stronger than strata properties. And again, let's say your mortgage was only 5 years. You may have bought the property, 10, 15, 20 years before that. So where the valuation piece comes into play is if somebody is trying to get back up to like 80% leverage, right? If you're not trying to max it out, there could be a few decreases on the value. But if you bought a property for 20% down 5 years ago, here we are 5 years later, and you want to refinance it back to 80% and the value's down, that is going to be a problem.
So you're kind of stuck taking your renewal in that.
Then you're stuck taking, or the other option is to pay down your mortgage by the difference than what the appraised value is. Right. So again, if you have the liquidity to do that, you can do that. Otherwise, you're going to have to renew your mortgage based on the valuation difference.
If you do want to stay with your bank, but you're still trying to get the best rate, what would be the strategy for that?
It's always never a bad idea just to threaten the lender and say, "Hey, I'm looking at other options out there." Lenders aren't in the business of, they want to make sure you're happy and so forth. So I don't think it's a bad idea just to nudge them a bit and say, "Hey, is this your, can you sharpen your pencil, or is this the best deal?" I think it's okay.
It's pretty reasonable.
It's okay practice to do. What a lot of people do. Yeah.
And speaking of lenders and banks, it seems like we've seen a shift in the market, especially in the last 2 years, where banks seem to be a bit more aggressive at taking business directly from clients, right? Rather than having clients go through mortgage brokers and other channels. Are you seeing banks being more aggressive at taking that business? Has anything changed in how they're qualifying people, or what types of clients they're looking to attain or retain?
Yeah, I mean, in the market as a whole, the business has gone more proprietary the last few years. Right. I would say prior to that, the process and the rates were, pretty similar between going direct to bank versus broker. It's no longer the case. So we are seeing a divide. Whether that continues long run, who knows? But right now, consumers that are going direct to banks are definitely getting better deals than going through external brokers, for sure.
So one of the first steps right now for people buying is probably to check with your bank first.
For sure, yeah.
And then shop around to other banks and possibly mortgage brokers as well.
Yeah, exactly. Yeah. I always tell people, feel free to do your due diligence, right? I want to make sure you're making an informed decision. Talk to your bank, talk to your broker, and so forth. But I also want to tell people, give them the direct goods and not waste their time. So, you feel free to use kind of who you want, and if you want to use us for a second opinion, that's okay too. But again, the model could shift down the road. But right now, again, it seems the banks are getting the better deals right now.
I know some clients get better rates than other clients, right? What are the factors at play that credit score is probably part of it, right?
Yeah,
the loan size, what
loan
can people
size is one thing.
Okay.
Typically the larger the deal, the better the rates.
Right.
Again, kind of a new shift the last couple of years, right. For banks.
And what would a large deal be considered in Vancouver? What's a mortgage size where it's you don't have much leverage versus where you're getting more and more leverage from the bank? What would you say?
I would say the difference between these rates, we're talking very small. We're talking 3 basis points, 5 basis points. We're not talking 0.2 or 0.3 or anything like that. We're talking very small, but I would say the kind of the top end of the tier is probably million plus loan size, which you see quite often in Vancouver, to be honest. Yeah. And kind of on the lower tier, I would say kind of maybe sub 250, something like that. Okay. But again, that could change, right? Right now, that's the model that a lot of the banks have adopted, but who knows how it is moving forward. So.
But I guess ideally they're trying to acquire those higher value clients right now. Good, more interest.
They're looking for healthcare professionals and lawyers and so forth. Yeah. And but yeah,
minimum down payments on the different price points. How it's different in Vancouver than other parts of Canada, really, right? What are those price thresholds again for minimum down payment sizes for buyers?
You mean for insured mortgages or
for insured? Yeah, and also you remember we were talking about over 3.5, you need to put 50% down.
Sorry, you're referring to sliding scale.
Yeah.
So sliding scale refers to the maximum a bank will lend in a certain region.
Yes.
So as an example, in the Lower Mainland, different pockets, obviously, different municipalities. So the bank will lend up to 20% down in Vancouver proper, West Van, kind of higher price points.
Up to what price point?
It depends based on the region. So typically it can go anywhere from, call it $3.5 million.
Yeah.
But as you kind of go to Burnaby, Richmond, Coquitlam, and these smaller markets, not that they're small, just from a valuation perspective, typically you can put 20% down on the first, call it $2.5 million or the first $2 million. So if you find, call it a $6 million property in Burnaby, and you want to put 20% down, it's probably going to be a stretch because finding a $6 million property in West Vancouver is higher probability of that than finding in Burnaby for sure. So what banks do to mitigate risk is they will allow 20% down up to a certain scale, which again ranges from 2, 2.5, 3, 3.5, depending on the region. And then anything more than that is based on 50% down, right? So it's like a blended down payment.
But it's just over that amount. If you're buying, $6 million in Burnaby, it could be 20% on the first $2.5 million.
Correct.
And then 50% on the rest.
That's correct. However, there are exceptions to that. Okay. This is where we look at the clients. If the client is a big income earner, they have high net worth. Are there exceptions? 100% there are.
Right.
Lending in general is based on exceptions. That's the whole business as a whole.
Right.
So yes, there are exceptions to that based on the property, based on the location, based on the clients.
Right.
So yes, that's the policy. However, can you get exceptions? Yeah. For sure you can.
What are some of those key things that you look for that you're able to show the bank that this is an exceptional client versus just like an average
I think
client.
it's just essentially in the write-up of the deal, and we talk
Right.
about the marketability of the property,
Right.
and why it would make sense for the bank to lend on that property and give
Right.
a scale exception based on the client's profile. Maybe they're in their mid-30s and they're in a high income earning potential in their career, and we just make a point saying, you know what, the reality is this client probably has the option and possibility of staying in this career long term, making more money.
Right.
You need to satisfy the other side to make them comfortable in the lending decision. So a lot of that is just due
So it's
to
really presenting the story of the
100%.
client more than just the straightforward numbers, because the
100%.
numbers every other bank is looking at.
That's right.
Yeah.
That's
Okay.
right. That's,
You're a master storyteller.
Yeah. Well, I wouldn't say a story. I think it's just about kind of displaying the facts in the most favorable possible way.
Right. Yeah.
Right.
Yeah. Well, and I think that truthfully, that's what makes the difference, right? I can't think of how many deals you've saved for us where it didn't get, approved all week. The client's lender had it to deal with it, and we call you on a Friday night, subject removal Saturday, and you somehow get it done, right? And
sometimes things work out in your favor sometimes, right? So.
One thing that we're seeing now too, speaking of, appraisals, is thankfully not many of our clients. We've had it recently with one of our clients, but we're hearing a lot of this in the market is people who bought in pre-sale, right? If they were pre-approved, they're in a good position, right? If they're pre-approved with a preferred lender for that developer. But if they weren't and they're getting financing now, a lot of times their appraisal value is coming in under the value of what they bought it for. Are you seeing that? And when you're seeing that, is what are the options that the client has other than just putting more money down?
So unfortunately, I have seen it.
Yeah.
To your point, you mentioned about the preferred lenders. Yeah. Oftentimes, the developers have preferred lender packages with some of the big banks, and the valuation is locked in. So, regardless of at the time of closing, on the market value.
So even if they didn't get pre-approved, like say TD was, because it's usually like TD, RBC,
it's usually
BMO,
the big,
right?
Usually, TD, BMO, RBC have kind of packages, but you have to apply for these, years in advance.
That's the thing. Right? So if you didn't apply 3 years ago when you bought it, they come to you now, even if TD was a preferred lender, you can't.
Matter.
Okay.
Yeah.
So you would have had to do it.
So
at the
that's
beginning.
why it's kind of the onus is on the client to apply, get your approval locked in, get the value locked in. Because if you don't want it at closing, it doesn't cost you anything. You can just go somewhere else, right? So you have essentially everything to gain by doing so. But a lot of people haven't done that. Yeah. So we are seeing, unfortunately, some values coming in. So option A is if you have the means to come up with the extra cash, then, obviously come up with the extra cash and close on the property. If you don't, maybe if you have something else, you can refinance something else, pull some equity out. We are seeing that. I had one not too long ago. They were buying a pre-sale. Value, unfortunately, was less.
How much less?
I think they paid like $850 and it came in like at $650.
Oh,
yeah. So it's kind of a big one. And, they were short. Yeah. But luckily they had another property. I was able to refinance that property through like a home equity line of credit product and then top up the difference on the new deal. Obviously, not a good situation right now. Yeah. Toronto's a little bit worse than Vancouver for sure. Yeah. But again, this is a risk tolerance again. Are things going to get worse? Yeah. Are they not? Spring market listings are coming up. I'm sure you'll be the first to say you're getting a lot of more listings right now.
A lot of listings now. Yeah.
How is this going to play out? Nobody knows right now.
We had a client recently who had bought a pre-sale.
Yeah.
They're closing on it now. The appraisal came in much lower than what they bought it for. We tried to see if we could find comps to dispute the appraisal, and there hasn't been any sales that were comparable, right? So it's finding that gap is there any opportunity for them to maybe go less than 20% and, add on a co-signer or anything? Are there any other creative solutions other than just coming up with that cash?
Well, yeah, the other option is potentially, co-signer, whether they're going added on title or having them off title, because if you have somebody temporarily as a co-signer, maybe down the road, once the values increase, you can refinance it and take the co-signer off. So, yeah, so that is another option. On your point about the values, if you have one person that undersells, that's now the new comp.
That's the hardest thing.
That's the hardest thing, right? And then that kind of sets the bar. And then people often say, well, that's just an outlier. I'm like, it's not really an outlier. They sold for that one. And that's what appraisers are going to use for values moving forward, right?
And that's the biggest risk we're seeing in this market now is, we can anticipate someone's value based on the previous sales. But after you're listed, if someone else comes on and they sell at a low price, that becomes your new benchmark. And it's very hard to overcome.
Yeah. That's why I always tell you, when you're dealing with your clients, I always say, make sure they put subject to appraisal in there, right? Just in case. On a purchase, in this market, there's a very good chance it's more of a formality. But in the event it comes in less than what they paid for it, it protects the bank, and it also protects the client. The client wants to know they're paying fair market value. So the appraisal is there for a reason, right?
Do you ever see banks reappraising properties now? Like, has that happened? I've heard stories about it. I haven't seen it happen.
We get that question all the time. Like, if when I appraised my property in 2021, the value was this, and I got a mortgage of this, and now 5 years later it's worth less. Are they gonna kind of eliminate my line of credit? The answer is no. They're not, because on the flip side, if your property value has gone up, are they just going to give you automatic new money? No, you have to apply for it. So it's based on the time of application.
So if you don't refinance,
that's right.
You're good.
That's right. It's locked in. So
that's our biggest challenge right now when we're listing properties. It's very hard to know if it's going to sell quickly, get action, not there's things that based on the comparables from a month ago, it looks a certain way, but once you get on the market, it's totally changed. Sometimes it works in your favor, sometimes it doesn't.
Totally.
Right? The market's moved from being a very speculative driven, that FOMO of like, just get into the market, and you had investors and first time buyers and everyone jumping in. Right now, to me, what we're seeing is a lot of people who are making moves are the people who need to move up in the market, or people need to move down based on life stages. So one of the primary ones that we work with is young families, right? Who are they're outgrowing their space. They have to move, right? And it's this decision of they want to sell and they want to buy. They don't really want to do either one before the other, right? Obviously, yes, you have the option of trying to do subject to sale, which we're seeing a lot more of in this market. Subject to sale does come with risks though, right? Because the seller could give you you have a 48-hour clause, and the sellers could give you note. So you're not guaranteed to get the property, but it protects you from owning two. For people who aren't in that position, whether the market's, the sellers aren't willing to accept it, and they don't want to sell before buying because they're worried about being homeless, right? Like selling before buying would be the easy thing to do in this market, right? The risk though is that you don't find a property you love. So some people are still wanting to try the strategy of buying and then selling, right? And the big thing we talk with them about, and we always send them to, is, well, make sure you have a backup plan for your financing. What do the numbers look like for people? Like, what do people need to be aware of in terms of how much equity do they need in their home, or how much has their income has to change for them to be in a position where they can have a backup
to keep
financing?
both properties, essentially?
Yeah, if it couldn't sell, right? Like if they bought and they can't sell the other property, or it's not selling at the price they want to sell for, what is a bank looking at?
Well, everyone's obviously situation is going to be different from scenario to scenario. But typically, if someone's in a current property right now, they want to buy a new property, and they do not want to be forced to sell. The intention is to sell, obviously. No one wants to carry, massive amounts of debt, but they don't want to let the new purchase go. So how do we work with that? So essentially what we would do is we would look at refinancing their existing home. Now you can lend up to 80% of the property value. If it's just a line of credit, it goes up to 65%. So this would only work for people that have equity in their home. If you're already kind of maxed out
So you need to have way more than 20%.
You need to have 100%. And if you don't, it's not going to work. So, but let's say for people that have, they bought their property long ago, they've been able to pay their mortgage down, they could essentially get a line of credit on their existing home. That line of credit would act as the down payment on the new purchase.
And what's the difference? Because I think line of credit, is 65%?
It's up to 65%. So what we would do is we would give them a line of credit on their current home. Let's say their current home is clear title, right? We would
say it's $1 million home, clear title.
We would give them up to 65% of that, subject to qualification, right? Which would be about $650,000.
Right.
They would then use that, or a portion of that, on the new property to act as the down payment. So then on the new property, we'd give them another line of credit or a mortgage on the new property. So now they have
up to what percentage?
If it's a mortgage, we can give up to 80%. If it's a line of credit, up to 65%. So it's going to depend on the price points. Okay. So what they've done now is they have a line of credit on existing home, and they have, call it a line of credit or a mortgage hybrid, whatever, on the new property. So now they own both properties. They weren't forced to sell. Fast forward a couple months, they sell their current property. Line of credit gets discharged, no penalties, because it's a line of credit. It's fully open, right? And then they can use the proceeds of that sale to apply to the new deal. So this is the exact same situation as someone selling having the money and buying, but you're in the interim, you're keeping both properties. But
and
again,
you're only making interest payments typically, right? So you could keep your monthly payments lower.
But I always tell people, hey, you can't predict the future because when the bank is approving you deals, it's based on definites. It's either they're selling or they're not selling.
Right.
So if they're not selling, the bank is assuming you're keeping both properties.
Right.
And what if the market gets worse? Now you're holding two properties. So you have to be comfortable with the debt load that you're taking for that period in time.
And have the option of either holding it and renting
100%.
it out or selling it at whatever the market's dictating, which could be significantly lower than what you expected.
So for a lot of people, they're not willing to take that risk.
Yeah.
Whether they qualify or not, because people are worried out there. Like, maybe I do qualify, but they don't. We had one of your clients not too long ago who bought a property subject to sale.
Yeah.
And I mentioned to her, I'm like, you don't necessarily need to sell. You have a strong profile. And we got financing not contingent on the sale. She ended up selling anyways, gratefully. So,
and she still wanted to protect herself and have that subject to sale.
That's right. But there are examples of people that are okay because they feel they're getting a really good deal on the buy and they want to make sure that they're getting it. There is something called bridge financing as well, but you do need to have a firm buy and a firm sell. So people think, oh, you just bridge the money. I'm like, your place isn't sold yet. You can't bridge. So a bridge is the bank giving you money for the buy because they know you have a firm sale on. And a firm sale is your subjects have been removed and you have the deposit from the buyers. It can't just be a listed property. So let's just say you have a firm purchase closing June 15th, but you have a firm sale closing July 15th. The bank will give you money on June 15th because they know that they're going to get paid back on July 15th. Bridges are typically 90 days. 90 days. But they do serve a purpose. And this way, you're not homeless. You can move into the new property on June 15th. Then you have 30 days to essentially get out of the other property. So
what's the rate like on a bridge financing versus like a HELOC?
Bridges aren't cheap because they're unsecured loans. They're typically based at prime plus 4, with prime being 4.45 right now. It's about 8.5%, 8.45%, maximum 90 days. But again, they do serve a purpose. Right.
And what's a typical rate right now on a home equity line of credit?
I would say kind of prime plus anywhere from 0.2 to 0.5, somewhere in that range. So kind of like 4.65 to kind of 4.95.
So just a bit higher than a mortgage rate.
Correct. Yeah, but they're fully open.
But they're fully open.
A mortgage is not fully open. Line of credits are fully open. So the more flexible, you can pay off whatever you want, whenever you want, especially if someone is getting a line of credit to source the down payment on a new purchase. They don't want a mortgage. They want a line of credit because it allows them the flexibility they need when, in fact, they do sell their property. That's right.
Well, and I know we had a client, my mom, who we moved across country, right, from Ontario to Vancouver. And it was really, as much as the idea would be to sell and then buy, she wanted a very specific property close to us. And we decided to take that chance, right? And it was a bit risky and it's very stressful, but without that, for a downsizer, right? For upsizers, it's a risk, you want to make sure you get value, but for a downsizer who's picking their potentially forever home, right? They don't want to have the risk of selling their home, being homeless and not knowing where to go. So these kind of strategies seem to work really well for downsizers as well.
Like in that example.
And typically they have their place paid off. It's, you could finance, like you said, 65% on.
Yeah, it's just an interim line of credit. And then once the existing property is sold, line of credit gets paid back to zero. But you're holding that debt for the time it takes to sell your property. As long as you're okay with that, but at least this way you're not forced to sell. That's right.
Well, and that's the nice thing too. I actually think for a lot of clients, it gives them more flexibility on the selling side because instead of being, even if you had a subject to sale, right, you need to sell in that 3-4 weeks, right? Or what? Because you're not typically going to get a much longer subject to sale period in there.
That's right.
And if you're getting, it's a unique property or it's taking a while and you're not getting that action and you're getting low ball offer, like you're in a position where you have to make that decision versus if you give yourself this line of credit, you could take your time and make sure that you get the right deal for you.
As long as you're okay with the interest payments during that time frame.
Yeah. So another big trend we're seeing in the market right now is buyers getting help from family members and parents trying to help their kids, right? Instead of leaving their equity and their net worth to be passed on after they pass away, they're trying to help their kids get into the market. I know we've been dealing with a lot of this. And what are the ways that you're seeing parents be strategic about helping their kids with purchases? And what are some of the risks and strategies?
You see this a lot, especially the lower mainland with the price points being so high. The reality is it's just very tough to get in. I know a lot of people get help. It's totally normal.
Yeah.
So there's two types of situations where family can help. So number one, kind of a traditional way is just essentially gifting the funds.
Right.
So let's just say you have a client that wants to purchase a unit, but they just don't qualify for it from a income point of view, from just, some information on that. Right now with the current stress test market qualification, you're looking at about 19,000, for simple math, call it 20,000 of income to qualify. So per $100,000.
Per 100,000.
Per 100.
Okay.
So if someone making $60,000 can qualify for 300,000, someone making $100,000 can qualify for 500K. That's the going number. So let's say you have somebody that wants to get into the market, but their income doesn't qualify for what they need. You can have parents as gifting the funds
for the down payment.
For the down payments, and maybe the client has their own funds. It's just not enough. And then so basically the gifted funds act as a down payment to essentially lower the mortgage amount to a number that the client can qualify for. Right. So that's option one. And you're seeing sometimes parents, if they don't have the money now, they're also getting lines of credits on their principal residence to use that to gift over to their kids for the down payment. So that's one option. Yeah. The other option is co-signing. Right. So we do have situations where you have parents co-signing their kids. So they may not want to come up with the, gifted down payment for now, or maybe not the entire amount for the down payment, but you can have them co-signing the deal. So one option is they go on the title with you, with the client. I guess the pros of that is the client can't sell the property without their consent. They can't refinance the property without their consent. But you do often see parents saying, I don't want to go on title. I will guarantee the loan, but I don't want to be on title. Yeah. If that's the case, the title stays 100% in the client's name.
Can they do that?
They can do that. They can be off title. So we always ask, do you want to go on title or off title?
And is that fully at the discretion of the client, or does a bank sometimes require it?
No, it's up to the discretion of the client. Like if the product allows it and the clients are okay with, you see both. Sometimes they want to go on title, sometimes they don't. Right. The title can stay in the client's name. Right. Parents are simply co-signing the deal, and then you're able to get a bigger mortgage based from a qualification.
But you still have to make those payments.
So got to make those payments.
Is that $19,000 for every $100,000 you borrow?
Yep.
Is that's kind of like supposed to keep people in their affordability ranges, right? So it's like you get mom and dad to co-sign now. You could borrow $300,000 for your night, but where are you going to get that money from?
Yeah, because the stress test is, that was implemented for a reason, and it's there to essentially protect the clients in the event rates go up. And what happened during COVID, right? Yeah. So that's why it's there. So when the rates go higher, the stress test or qualification to income goes up higher too, and as rates go down, qualification also goes down. Another kind of good snippet to provide people is on that income threshold, 19,000 per 100K. On a 30-year mortgage, it's approximately $475 per $100,000. Right. And on a 25-year mortgage, it's about $525 per $100,000. So these are monthly payments. So if someone's borrowing $500,000, we simply take 525 times 5, right? Which ends up being 26, 25. Yeah. So I always tell people, what you qualify for and what you want to spend are two different things.
Two different things, yeah.
Completely different, right? Because when you're renting, you're just paying rents. Yeah. Now you have your mortgage, you have property tax, you have strata, you have insurance. Yeah. Right? Yeah. So a lot of people, want to get into the market for sure. And if they're comfortable with the numbers, they will. So these are some good high-level numbers, qualification and payment-wise as well.
And we're seeing a lot of that. Actually, a lot of our clients seem to be, they're qualifying for more than they want to spend. The problem is what they want to spend and what they actually want in a home don't always match up to. So there's this sweet spot of typically people have to stretch a little bit, but you don't want to overstretch that you can't afford your payments, right? It's
Exactly. I always tell people, talking about, kind of value added. And I say to people, no one can time the market. Nobody knows. If you're comfortable with the value, if the value you're paying for the property, and if you're comfortable with the numbers from a dollars and cents perspective, make the plunge. Yeah. It's very rare you see someone after the fact saying, "Oh, I wish I didn't buy this home." Most people are comfortable with the house or a condo that they buy. Valuations go up and down over the long haul. There's a long track record of values, kind of coming up. Yeah, the last couple of years, have they been great? No. But if you're comfortable, I always tell people and, make the plunge and, more often than not, it's the right choice. So.
And really looking at it as a long-term.
100%.
Right? It's really, I think that's what we've lost sight of in the last few years is everyone is looking at what's my property going to be worth in 2-3 years. Even now we're getting clients like, what do you think my property is going to be worth in the spring? And it's very hard to predict the short term, right? The value of real estate is just paying it off in the long term.
Totally.
Right? And having somewhere to live. Now, with a parent with a parent co-signing on a mortgage,
Yep.
that means that when the renewal comes up, either the parent has to stay on the mortgage or you have to refinance then. Is that
so
correct?
it doesn't have to wait till the renewal. It can be at any part. So let's just say during the term of the mortgage, the client has now, their income's gone up, their assets have gone up. They have to have a stronger profile now than they did at the time of the actual mortgage. If they can illustrate that they can requalify for that mortgage without the parent co-signing, we will allow that.
You will allow that.
That's right.
So is that considered a full refi? Like, do you have to get the property appraised?
It's a brand new deal.
Okay.
It's a brand new deal. You have to go through the qualification process from scratch.
And I guess that's the same as, if people bought a property with someone else, right? Whether it was a partner or another family member, and now they want to take one of them off, you have to go through that full
It's a brand new deal.
refinance.
It's a change in title. Yeah. So if they bought it a couple years ago, for sure, there's going to be maybe a valuation difference, especially in a condo.
Are you seeing any clients like that who the parents maybe want to get out of it or spouse wants to get, but they just, like in this market, they're not able to do that refinancing? Or is it
you are seeing that, or some people are just actually selling the property rather than, because you see two situations. You see some people where one spouse will stay in the property, right? They will refinance the property and then use those proceeds to pay out the ex.
Right. Yeah.
Assuming they qualify, because when they bought the property, there's probably double income on the deal. So some people, if they can qualify and stay in the property, now it's just one income, refinance it, pay out the ex if they can. If they can't, then they have to sell the property, split up the proceeds based on whatever the terms are, and then use those new proceeds to buy their own property.
Right. Yeah. And I guess overall too, like, we're having a lot more strategic conversations with our clients. It sounds like you are as well, right? In this market is really walking them through all the scenarios and all of these factors, whereas before it wasn't really an issue because the property value had gone up, rates were low, rates were dropping, so it was much easier transition to make, right?
Things were just flying off the shelves, and it was just like it was a flow, and it's not like that now. Rates are higher right now, prices are kind of coming down-ish, and people are like, when's the right time to buy? So these are all...
You're taking a risk when you're buying, you're taking a risk when you're locking in your mortgage or not locking it in, right? Yeah. You're kind of taking a risk all throughout. Parents are helping their kids. Is there anything that you see parents are overlooking or making mistakes with? Like, in that case of, for example, gifting the down payment, right? Now there's a risk that, they're not on title.
What I am seeing is, I always ask if they're going with the co-signing route, because if someone co-signs the deal, whether they're on title or off title, whatever the amount they're borrowing does show up as a liability. So if someone is wanting to, usually, not always, but let's just say they want to acquire their own financing in the future, that co-signing deal they did will hinder their ability to borrow money.
Even if they're not making payments on it.
Even if they're making payments. So that is something they should be aware of. And we always tell them that, saying, hey, if you're planning on staying in your current home, at your forever home, that's fine. But if you're maybe going to downsize or maybe get a small mortgage or a line of credit, yes, it is going to impact your ability to borrow money for sure.
If you were gifting your kids money, I guess if you're trying to help your kids in the market, which of the two options would you take?
I would probably gift them the down payment and then let them take care of it.
Right.
That's what I would probably do. And then they're responsible for the payments because they're qualifying for that mortgage based on their own income, right? Meaning the bank has already gone through their vetting process saying the client can qualify for this based on their income. So you're not up at night wondering if your kids can make their mortgage payments. That's right. And I guess another thing, which is more of a lawyer thing, but if you're gifting those funds is, finding a way to possibly secure that, like if the partner ends up getting married or something, Yeah, more of a legal, there's a bit of a risk of question, that equity. You do see people registering a charge after the fact, like post-closing, just to protect the family's interest. Yeah, more of a legal thing, so probably best to talk to a lawyer. But yes, you do see family charges. Maybe they get into a bad relationship and the parents don't like the spouse or boyfriend or whatever. It does happen. And they don't want that spouse ending up with half the down payment. That's right. What are kind of the most stressful situations you've seen clients in? I think the most stressful I've seen right now is probably two things. One is their renewal. So they stretched in 2021 to get their property at a rate of 1.59, whatever, 1.69. Yeah. Here we are 5 years later. Yeah. They can't requalify for the 30 years because their profile doesn't warrant a refinance. So, so there are some people that are paying. Remember we talked about $1,000 extra payment. That's a lot of money.
Yeah.
Right. So now they have to cut out other discretionary spending.
Right.
So not a great situation.
Or they sell the property or.
Yeah. Right. So you are seeing that. The situation I had recently with the 850 condo going down to 650.
Oh yeah. Yeah.
Yeah. They weren't happy about that. Right. Obviously.
Yeah.
And it's stressful for people. So before you weren't seeing that because people were buying pre-sales and the value kept on going up and up and up. And right now we're not in that market.
Yeah.
We're seeing a lot of volatility. Who knows how much lower these prices are going to come down. So time will tell for sure.
Recently, we had some clients talk to you. They were pre-approved with the lender already, right? Then their file came, and then we encouraged them to shop around. And like you said, they actually had a good rate locked in, but the advice they were given was,
the advice piece wasn't great. So that example was actually on an insured mortgage. So for people that don't know, any mortgage in Canada with less than 20% down is subject to government default insurance. So 20% down, no insurance. Under 20% down, there is insurance.
Yeah.
So the first question I asked them is, I said, how much are you putting down on the down payment?
Yeah.
And based on the purchase price, it ended up being like 17 or 18% down. So insurance premiums are based on percentages, not dollar values. So what that means is there's a certain insurance premium at 5%, 10%, 15%, no insurance at 20.
Right.
But because they were over 15%, but less than 20%, they were still paying the 15% insurance premium. And we calculated it to be like $22,000.
Right.
So I said, well, you're so close to 20%.
Yeah.
Beg, borrow, and steal to get the extra money to get to the 20%. Because even if you're, borrowing it or getting from family, you're saving $22,000. Right. So that advice piece,
and probably even more on the interest than you're paying.
Well,
no?
Yeah, for sure. Yeah, because that's the insurance cost is a one-time fee that gets added to the mortgage.
Right.
So
it's paid. It's added at the beginning, and then it's amortized over the life of
the term. So even if you sell the property a month later, that's money's gone.
Right.
So there's the advice piece, asking the right questions. Yeah. Now, typically, we don't really do tons of insured mortgages, to be honest. Usually, a handful a year max. Yeah. Usually for people that are going insured, it's usually on the lower side of the down payments. It's like I'm putting 5% down or 10% down. You don't really see people putting like 15% down. So on the lower side, if they only have a certain amount, make the plunge, pay the insurance, buy your property. But if you're close, try and get to the 20% because then you can get save on the insurance cost.
But what are the questions that people aren't asking that you think they need to be asking to make sure that they're getting the right? How do they even know if they're getting good advice or not? Is really a tough thing.
I always tell people, I always say, talk to whoever. A lot of people feel comfortable with their own broker or their own banker, and that's totally fine. Have a conversation with them. Have a conversation with us. Yeah. And, if you're just looking for a second opinion, especially with your clients, I always tell people, I work well with Adina. If you just want to chat, happy to give you guys advice. So this is just, call it a discovery phase, asking them everything from like their down payment, their plans on the property. Is this going to be a short-term thing? Is it going to be a long-term thing? Are you planning on keeping it long-term? Are you planning on upsizing in the future? So it's just essentially having a good conversation piece. I'm old school. I like to pick up the phone, as you know, and just talk to someone. That's it. Yeah. I think things get kind of in this day and age with technology and texting and sure. Do we communicate that way if we have to? For sure. But I think if you can just pick up the phone, make the time and understand someone's needs, you can avoid a lot of
the clarity.
100%.
As a buyer though, like what do you think are the questions they should be asking that they don't normally, like to your point about the insurance premium, and then what would be the difference if they're putting 20% down versus 18 as one?
Yeah, I would say like one thing that, a lot of people don't know about is like mortgages and home equity lines of credits. Like people know the term HELOC. What is that, right? Yeah. So a HELOC is essentially, if someone takes a traditional mortgage, it's called term reducing, meaning as you pay it down, you don't get access to what you pay down. Someone borrows $800,000. Now the mortgage is down to $780,000. That $20,000 that they paid back, they cannot reborrow it. Right. With a line of credit product known as a HELOC product, you can. Same thing. You're borrowing $800,000. You've paid back $20,000. But now that $20,000 can be reborrowed in the future. Right. Why this is important? Someone has access to equity at their fingertips without reapplying for it. If they don't use it, there's no cost associated with it. Maybe they have a levy on the building. Yeah. Maybe they want to do a renovation. Maybe they want to help somebody else or buy another property, because these lines of credits, as you pay your mortgage down, you have access. So that's...
And usually it's a combo of both, right? Yeah. Like when someone's buying it, so you're getting a mortgage and then the HELOC
That's right. It's usually
option on it, right?
That's right. So yeah, and it's, I always ask people, these are the two products, what do you prefer? And more often than not, almost everyone's going to take the line of credit product because it's just a better product, right? I think I had one person years and years ago said, I can't control my spending, and I'm just going to use the line of credit.
Good for them that they're disciplined.
That's right.
That's good self-awareness.
Besides that, it is good to have as a safety net, for sure.
And does every bank do that, or is that more or less?
All the big banks have it. All the big banks have that product. I think they call it something else, like different names, but it's still access to equity against your home through a line of credit that's interest only and fully open. So yes.
Mm-hmm. And what about our big thing when we're advising people to talk to their lenders? For us, it's all about getting the deal done. And we always tell clients, if you lose a property because someone's willing to pay more than you, then that is what it is. Yeah. But if you lose it because someone had a quicker turnaround because they had a better mortgage person, or they had an inspector on site. If they lose it because they weren't set up properly, then I feel like that's on us that we didn't set them up. So one of the things we often encourage them to do is when they're talking to the lender is seeing what those turnaround times are, right, for the actual approval. And I find it varies anywhere from, when we work with you, it's 1 to 2 days. Sometimes they come back, they're like, oh, it's 10 business days, which in Vancouver,
it's too long.
It's too long, right?
Yeah.
It's short. So that's one of the primary questions we ask. What do you see as average? And what do you guys?
I would say the rule of thumb is kind of 5 business days. I'm sure you'd agree, 1 week.
Yep.
Right?
I
because
think that's
the lender may want to do an appraisal. So things have improved with technology. So not before, almost all properties required a full appraisal. Nowadays, there's an automated one where no one's even going to the property. They also have desktop appraisal. So people are doing it behind the scenes. Then if the system does not agree with the value, then it would be a full appraisal. So if it's automated, it's instant. Yeah. Desktop appraisal, maybe 1 business day. Full appraisal, maybe 3 business days. Right. So
and do you find the automated ones more likely in condo, in standard product, right? Or
standard product, but generally they can be for stuff under $2 million.
Okay.
Right. So if the algorithm agrees with the price that the client is paying based on comparable sales in the neighborhood, it won't order an appraisal, right? Because people want to be more efficient. So typically on price points over $2 million, full appraisal is required, right? So, but I would say to your question, 5 business days is normal. If an appraisal is needed, typically order that right away. And then, the inspections kind of order that kind of towards the end, because you want to make sure your financing is approved first before you order the inspection, right?
Yeah, although inspectors are very busy these days, so we kind of have to order them early on, but make sure that you get it before the subject removal.
Yeah, that's right. So, standard subject to appraisal, because we just don't know. What if, with the values being so volatile right now, you want to make sure there are comparable sales to match the value of what the client's paying. So.
And once that approval happens, if they've gotten the desktop appraisal or the in-person appraisal, there's no more appraisal before closing.
That's right.
There's no chance of that.
It's locked in. So the appraisal's locked in and the rate's locked in. So if rates change over the next, let's say there's a longer closing, 90 days or 120 days, the rate's locked in. So if they go up, client's protected. If they go down, we'll drop the rate as well. So.
What about buyers who are buying when you need to give notice to the tenant? So then sometimes the closing could be more than 120 days out.
Yeah.
Will the bank give an exemption on that if the deal's locked in, or is 120 days?
120 days is typically the norm, but again,
yeah.
Ember said lending is based on exceptions. Yeah. That's the whole lending business. So we'd obviously ask for an exception. Whether we get it or not, we don't know. But you don't know that.
But you'd know when you do your approval.
For sure. So you don't want to put your client in a position where they're buying something and then being forced to sell, because up until a couple of years ago, whatever someone listed, they were selling.
Yeah.
So people would buy a property, ask for a long closing. Yeah. 120 days out. Oh, yeah. Don't worry, I'm going to sell my property. And they were. Yeah. It's not the case anymore. No. So you are seeing some people that unfortunately need to buy or sell their property. Yeah. They don't want to, but they have no choice because they bought that property. Yeah. So we always tell people that, hey, if you're telling us that we're giving you financing on a new property and the onus is on you to sell your property, that's on you. Yeah. Right? Because if you don't sell it, where's the down payment coming from? Yeah. So people often have to scramble. And so I always tell people, talk to your realtor, make sure you understand.
Or make sure you could hold both properties.
If they can. Some people can, a lot of people can't. Yeah. Right? And if that's the case, that is risky. I think it's all about
yeah.
setting up proper expectations.
Yeah.
Right.
And setting up backup plans. I think to us in this market, you hope for the best and you plan for the worst. And it's like, what's the worst possible scenario? If you're covered in that case, then you can move forward.
Yeah.
If you're not, don't do it.
No one likes to be blindsided, right?
No. And we don't like that pressure on us. Because in this market too, what you're also seeing is you might get an offer right away, but then if that offer doesn't remove subjects, right? Now you're back at square one. Like it could just take so much longer in this market to even get that accepted offer. To remove conditions and become firm, you have absolutely no control over it. And I'd say that we're seeing more deals fall apart because of financing than I've ever seen in a decade. Which is interesting because a lot of those say they're I think it's just people who aren't fully pre-approved or things coming out of the...
They're just using maybe the cold feet. Or using their subjects to clause just to kill the deal. Yeah.
Or their lender made certain assumptions and it wasn't a real pre-approval, right? Is the other one. Yeah, so let's talk about qualifying.
So qualification. Lenders always will use income to qualify.
Right.
Always. That's the way it's been. That's the way it's going to be.
Right.
Cash flow, which is your income. Money coming in, income versus money coming out. Mortgage, property tax, strata, car payments, right? So if you're within these ratios, do you qualify? Yes or no? Simple as that.
And the ratio was $19,000 for every $100,000 you borrow on average. If someone has good credit.
Yeah. So I mean, credit's important for sure.
Yeah.
People often say, I got really good credit. I'm like, yeah, but you don't have the income to qualify. So if you don't have the income to qualify, you cannot display that you can make your payments. Right? So yes, is credit important? It's okay.
Yeah.
It's you can have fair credit and get an approval. Income's the main thing.
Right.
So we do have situations, especially there was a client we worked with not too long ago. Personal income, not very high. Right. But they still had assets, strong income in their corporation. So what you see with a lot of professionals is that they only pay themselves X to keep their personal income low for tax purposes. But the reality is they could pay themselves more if they wanted to, but they choose not to because why pay income tax, right? So those types of deals, self-employed clients, even though they don't necessarily have a huge personal income, which is, again, the primary indicator when qualifying a mortgage, it's not the only indicator. So, we like to look at the whole thing. So there's like net worth programs, income from financial statements. So it's not just 19,000 per 100. If you're within that, you qualify. And if you don't, you don't. It's not that simple. There are other programs that the bank looks at to kind of make a more common sense approach when it comes to lending. So that's why it's good about having that discovery chat with somebody to get a full understanding from a qualification perspective. Because yes, we will always, no matter what, always ask for your personal income. Right.
Yeah.
But it doesn't mean it's as an example, let's say you have someone that's retired.
Yeah.
They don't have personal income. They're retired. They're getting, CPP, OAS, maybe a RIF.
Yeah.
But they probably have a portfolio.
Right.
So we will mitigate risk by saying, yes, their personal income is low, but if they ever needed to draw income out of their portfolio, they can. Right. So I always tell people that yes, qualification is income-based, but it's not the only thing. So we will try and be creative and look at any program or strength of the client to kind of fit into a box and qualify them.
And that actually brings me to another point is people who are buying properties in their holdcos. I know I went through, and that was TD's one of the, seemed like one of the more, what's the word? One of the banks that looks at it a little bit more favorably in terms of like allowing like a personal mortgage on a holdco property versus treating it as a commercial mortgage.
That's right.
Yeah,
so a lot of the big banks will do holdco financing. Yeah. So basically the title of the property is owned by the numbered company or whatever the company is. And the guarantor of that mortgage is simply the individual. Right. And the nice thing about the big banks qualification is you still, if it's under the residential channel, you'll still get the same leverage as you would as a personal mortgage. And you get the same rates. So you're not paying a premium for that.
And what's that difference between, because I know I had talked to two different banks when I was looking at one of them was CD, which we went, and I got the residential mortgage. The other one had said, no, it has to be a commercial mortgage. What's that determining factor of whether the bank's treating it like a residential mortgage or a commercial mortgage if you're buying in your holdco?
I just think it's kind of own internal policies of the bank. I think some banks are comfortable lending under the residential channel to holding companies. Some other banks aren't comfortable doing that. So they just pawn it off to commercial. So typically on commercial, maybe higher rates, less leverage, meaning more down payment, right? So I can't speak on behalf of all banks, but there are lenders out there that will lend to holding companies on the residential channel. You are seeing typically holdco purchasers or a little bit more savvy. You get the savvy investors that want to, purchase properties.
Yeah.
So those are like usually affluent clients.
Yeah.
We want to lend to those people.
Right.
So we'll look for programs that kind of meets their needs.
And are rates pretty like if they're getting a residential mortgage, it's the same thing?
There's no premiums. Yeah. It's the same thing.
Okay.
Right. Again, I can't speak for all lenders, but from our experience, the lenders, doing these deals typically price them the same.
And talking about income to qualify when people are self-employed, I know that's one of the more like not all income is treated equally, I'm assuming, right? Like if you're getting income from, because you work for the government and it's been consistent for the last 10 years versus you're self-employed and you're getting an income, what's the difference that the bank is looking, like how does a bank weigh those different types of income?
So for someone who's incorporated, we'll look at their corporate financials and then look at their income statement and say, well, person A only pays himself, 50 grand or 100 grand from a qualification perspective. But if we look on the income statement and see that there's some add backs that they can do, like net income that they can add back to the deal, we will look at that. Okay. So every bank views these programs different. It's called stated income. That's what the program's called. Stated income refers to the amount that you're stating that you make. Right. If you can back it up with your financials, no problem. We'll lend to that. Same thing. You can get same leverage, same rates. Because
what if the income's been like how many years? Like
2 years.
So you need 2 years, and it needs to be around the same amount, or they're just averaging the 2 years.
It has to be somewhat similar because what if 1 year and the income is huge,
50,000 and the other?
Then the bank will say it's an outlier.
Right.
Right.
Which one? The outlier.
So you have to look at it as an overall. It's all about a business case based on exception lending. Right, if someone has 1 year low, 1 year high, but it makes sense on why it was that way, and you can explain it. Sure, maybe we'll do a 2 year average. Mm-hmm. If they want to look at previous years to show, hey, here's the last 5 years,
and they just had one bad year.
Yeah. So we try and exhaust all those things for sure. But if we didn't have these programs, how could we lend to professionals? Yeah. Because they keep all their income in the corporation, tax sheltering. So we have to have these programs to essentially qualify clients for sure.
And another thing we're seeing right now is people who have concerns about losing their jobs. Some people who have lost their jobs, some people who are entering new jobs. 2 questions for you is if you've been approved, so say you've just removed subjects on your property, you paid your deposit, you're closing in July 1st, and now you lose your job after you've been approved. Does that make any difference? Does a bank check in on that? Do you have to report it?
No. Once the income is signed off on, they're going to honor the mortgage. That's right. Yeah.
And what about someone who's maybe lost their job or they've quit their job and they're starting a new job? Mm-hmm. How much history do you need in that new job for the income to qualify for the mortgage?
So usually with probation, they're 3 months. Sometimes they're 6 months. If somebody's brand new outside of school and they're in a brand new job, we'll typically ask to make sure they're past probation. Okay. So past the 3 months. If somebody's in the same line of work, same industry, and they just got a new job and they're on probation, again, based on the situation, generally not a big deal because
as long as it's similar income to
same line of work, and that's okay because people get new jobs all the time. It happens. So I would say yes. If you're in the same industry, doesn't matter if you're on probation or not. Right out of school, you have to wait 3 months.
Yeah. And then if you're pre-approved, if you lose your job before you get the approval, that's no bueno. But if you remove your conditions after you're
because they're going to sign off.
But then you're still going to need to find a new job to pay your mortgage. Right?
Yeah, exactly.
Yeah. Knock on wood, it's never happened to our clients, but they get an approval, then they go sign off and get like a car lease or some other like loan payment before the closing. And that affects the actual closing. Have you seen mistakes?
No, because usually once the bank signed off on the deal, they don't do a recredit, like a new check.
They don't. Okay.
The only time they would do that is if you're asking for more money. Let's say you went to the bank saying, hey, I'm putting 30% down. Right. And then the bank gives you an approval based on 30% down. And then you fast forward a month or two, still before closing, and say, hey, I now want to do 20% down. So you're asking for more money. Then it's going to be new income, new everything, because you're asking for more money. Right. If you're asking for less money, the bank doesn't care because it's less money. Right. But if it's a new money, that's considered a material change. So it's a brand new deal.
Okay. If your mortgage is not coming up for renewal yet, but your rate's quite a bit higher than what you could get in the market now. Yeah. Are you seeing some people break their term in order to requalify and get it? Is it worthwhile in this market or not so worthwhile? Like in what kind of scenarios have you seen it? Like if you could give an example of where it makes sense and an example where it doesn't make sense.
Yeah. So all banks have different types of penalties. Right. Okay. So if someone's sitting in a current variable rate mortgage, usually 3 months interest to break the mortgage. Very simple, very easy to calculate. Fixed rate mortgages are based on 3 months interest or IRD, which is interest rate differential. The bank will charge you the higher of the two. Okay.
Right.
So basically, we ask someone if, let's say they're in a lot of people took a mortgage in fall of 2023.
Right.
Okay. Rates at that time were the highest they were. I think rates kind of were in the 6% range. That's when rates kind of peaked, fall of 2023. And let's say they have 1 year left on the mortgage. We do a kind of a cost benefit analysis. So we say, find out what your penalty is.
Right.
And then we calculate, hey, if your penalty is, $5,000, but your cost savings is $10,000, let's do it. Get you out of your mortgage early, and get you into a lower rate mortgage, and the penalty will be offset with the lower rate. But there are situations where, depending on the lender and how they calculate their penalty, because again, all banks calculate penalties differently. I have seen situations where it doesn't make sense.
Right.
So the main thing to find out is find out what the penalty is first. And then it's simple as just doing math.
And how do you find out your penalty? Like, obviously 3 months of interest is easy when it's variable. When it's fixed,
you need to contact the lender.
And they'll tell you, like, on the phone, like, they'll calculate.
They'll tell you, what they'll say is the penalty is this, subject to change. So when I say subject to change, if current rates change, penalties also change.
Because if the rates drop lower, now the penalty could be higher.
It's an inverse relationship. That's right.
Interesting. And then the longer you have left on your mortgage, the higher that's going to be.
There's so many variables that go into essentially determining the penalty. So if somebody needs that analysis, first thing I say is find out what your penalty is, and I'll work backwards for you and determine
what's the most you've had someone save on a situation like that
I've seen people save like $40,000, $50,000.
Really?
On a bigger mortgage for sure, yeah.
Like, what size of a mortgage would that be?
I think at that time the mortgage was probably about $2 million. Okay. That's pretty big savings.
Yeah. So what was their penalty, and what was
I think the penalty was maybe like $20,000.
But they saved 40, 50. So
correct, yeah.
Interesting. So I guess anyone who has a 6% mortgage should call you and check.
Sure. Yeah, but a lot of those mortgages are coming up for renewal.
Anyways.
Right.
So you might as well wait.
Yeah.
And then what's the period that you could renew early? Like, if your mortgage renewal is coming up in 3-4 months, what's the earliest you could renew without having to pay a penalty?
Every bank is different. Okay. Market norm is, I would say, 4 months. Some banks do 6 months.
So you don't have to pay a penalty if you renew within that 4 months.
You renew within 4 months. You stay with your current lender. And then by doing so, you get out of your higher rate 4 months early. New one kicks in.
Right. We just did that. That was great. I was like, the first time I got my mortgage statement in years, I'm like, oh, this actually looks better than it did when we got the mortgage, right? So I guess to close it all off, what advice would you give someone if they are looking to buy or upsize or downsize in the market in the next 12 to 24 months? What would you say to them from a finance perspective?
Don't try and time the market. Right. Nobody knows. Could it go up? Could it go down?
Yeah.
Make sure you're comfortable with the property. Assume that you're not going to sell it anytime soon, because you're probably not in this market. Yeah. And if you're comfortable with the payments, make the plunge. Right. And don't listen to outside noise. Everyone has their friend. Oh, don't buy right now. Don't buy right now. Just forget about that noise. Go based on your own decision or your family's decision to make sure the space meets your needs.
And what you need.
100%. I always tell people that. Yeah. Generally, it's good advice. So.
That's generally good. Very good. Awesome. Well, thank you so much. I mean, that was very informative.
Thanks for
got
having
lots
me.
of notes here, and looking forward to getting this out to our clients.
For sure.
Thanks so
Happy
much.
to help. Thank you.